So the opposite of absorption is momentum. As I said in the very first section of the order flow week, that there's really two competing sides. There's the absorption side and the momentum side, and that really guides everything. All of the other aspects of flipping, large orders, anything like that are sort of short-term variations. What we're gonna have a look at now then is momentum. As it happens, what it shows you, how you can trade this. This is the kind of, the bigger, faster moves, the kind of stuff that people get excited about. So let's get on to this. What momentum is all about is a sustained change. That's the key bit. So it's a sustained relative increase in velocity, in volume, in activity. You don't have to have ticked all of those boxes, but you need some sustained shift. So this might be, for example, a market sitting reasonably still and then going from, say, trading 10 lots into the offer, it's suddenly 50, 50, 50. That's going to be a change. That's enough to create a necessity to move. If you suddenly see people coming in and buying, you know that it's perhaps time that you need to get on with this because you may not get filled if you don't do it right now. So where does this happen? That's the other thing. And with order flow, as we approach the end of the order flow week, the thing that you have to always think about with order flow is, where do I expect this to happen? It's not about being able to identify it afterwards, because that's the problem, that if you identify it afterwards, great, you can say, look, there was some momentum. You have to be able to identify where you expect this to happen, and then as you get to that point, know what that momentum is going to look like. So the obvious place, of course, is any kind of technical breakout, and we know that time frame's key here. The great thing with a technical breakout and momentum is that the momentum, and I'll show you this in the first examples that we look at, is that the momentum to break perhaps a small technical setup provides you enough movement to reach then a much larger, much more significant level. So it's this combination of setups, or this combination of points where you expect momentum to come into the market that can lead to very, very large, very fast movements. That's the first thing we'll look at, how to recognize the shift in momentum into what I would call an execution zone, and use that then to leverage your trade up to get into a position before the move actually happens. The other time that you're going to get momentum is when you get new information. Now, this doesn't necessarily always have to be news related. It can be a sudden shift as you get a correlated move in other markets, for example. Suddenly someone has some business they need to do and they start to act. So this is more a situation that may appear mid-range, may not be sudden or obvious why it should be happening. But what this helps you with is then driving the market in one direction, particularly if you have a market that's already balanced, it's ready to move. If you have that, and then you see new information, whether you know what the information is or not, being expressed in the market in terms of this pickup in velocity, volume, or activity. As soon as you see that pickup, you can act, and you can also have conviction that this is going to create decent movement because you've got the structure to allow for this. So momentum is really helpful when you've got some kind of structure. If you don't have a great deal of structure, then what you can end up with is very short-lived momentum. Somebody's got some business to do, bang, 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 business done, market stops moving. So don't get sort of trapped into assuming that every sudden little bit of movement is momentum. It's so important to understand where that's happening and how you're going to be able to apply that. There's a few different ways that we'll look at as how you can use momentum. Now, your aim using momentum is to enter in the direction of that, velocity increase, the volume increase. What this allows you then to do is to play a break. And this is the part of trading I think a lot of people aren't that keen on. They don't want to go hitting market into highs, hitting market into lows. It's fine to do that. As long as you've got the velocity to do it, you've got that volume backing you up, then you can get into the trade. And with momentum, it continues to tell you you're right. That's one of the great things about momentum. Whereas with a more passive trade, if you're buying on an absorption, it gives you the entry point. It shows you exactly where you can enter. But it never really says that you're right on the trade until you perhaps move through another technical reference or the market starts to push you on side. Whereas with momentum, as it starts, you can enter, and as it continues to say you should stay in. Once the momentum dissipates, then you can think about exiting the trade, getting out of the trade. So it's about watching that sustained momentum. Think back to the first section where we looked at the velocity and acceleration graphs, the kind of physics of it. As long as that velocity remains, the move can sustain. As soon as it changes, and we'll look at this when we get onto momentum reversals, as soon as it changes, now you know something's different, now you know you can start to exit your trade. And we'll look at different ways that occurs. What it's all about ultimately, and the simple summary of momentum, is that it all boils down to price personality. You're looking for a change. And as I've said a few times, it's not about trying to define exactly what the change is. This section is going to illustrate different ways in which you can see this type of change and different points at which you can expect to see it. But it's about recognizing there's something different. When you identify that, that leads you or allows you to get into a trade. And once you've allowed into a trade, wonderful. You've got everything you need, you can get in and you can then play that movement. So all about price personalities, the simple summary of how you're going to interpret momentum. Right. So let's go and have a look at what we're going to be covering over the next few sections. Distinguish your types of momentum. There's 3 key different types of momentum. You get the more sort of typical, or what I think most people assume when they think of momentum, and that's your initiative or sustained momentum. And this shows itself up in what we'll look at: trigger trades, where you get a market that sets up a further movement with an acceleration. We'll see passive continuation trades. Look at how you can use momentum after a break has happened. So if you've missed your entry, or if you don't get the opportunity to get in on that, how do you play the trade afterwards using what we call a passive continuation trade? As long as momentum is staying up, you can continue to get into the trade or even add on to a trade as the market moves. This is perhaps one of the best ways that you can leverage a position up. Absorption is not so easy to leverage up. You can increase size whilst the market is absorbing, but ultimately you continue to do that all at the same price. And so you're increasing your risk and trusting that what you're seeing is right. With a passive continuation trade, you're shown again and again and again that you are continuing to be right, in which case you can continue to add on to your trade. We'll look at the more sort of simple break points in these final 3. A velocity increase. Simple trade where you're expecting a market to break and you're just waiting for some change in the way the market's trading, and that velocity. You see a few more orders go through. This is a very nuanced type of trade. It's very subtle, gives you just enough to think now's the time. But by learning, just that movement over 2 or 3 ticks is enough. That can give you that little bit of conviction, that little moment that says you can do it now. Whereas if you're just looking at it from a candlestick perspective, even from a footprint perspective, you don't see that shift in interaction. You don't get that little sense that now's the time that it's about to happen. We'll look as well at pressure build trades, where a market pressures itself onto a low or into a high, holds itself, will not allow any kind of backwards movement. This then is forcing action into a breakout point. So you're creating momentum into the point where you expect the market to accelerate. And so this pressure then sort of drives the move onwards. We'll go and look at how you can use that to preempt a break, how you can get in before the market actually goes. And then we'll also look at a snap and run. This I kind of use as my sort of contingency. It's your last chance in. And it's quite common on a trade where you don't get any kind of obvious pre-entry. You can see the breakout point, you can see the point where the market should pick up momentum, but it never shows you anything. So you get there, you have nothing to do, you can't get into the trade. With a snap and run, you know that at the point of the break, you're expecting a little skip, you're expecting something to happen. When you see that little snap, that's the bit that says, now you can do it. It gives you just enough information. These 3, pressure build slightly less so, but those 3, quite subtle in the way they show themselves and give you the opportunity to get in without necessarily too much of a preemptive situation, as you may have with a trigger trade or a passive continuation trade. We'll look as well at the end of momentum, because momentum won't necessarily always continue in the same way. And usually the kind of the first thought about the end of momentum is that a market will just slow down and then it will decelerate and turn and trade the other way, like we talked about at the beginning. But you can also have the opposite of this, where you get liquidation trades, the final sort of exhaustion rush part of a move. We'll also look at stop hunting, how you can predict where stops are, plan where you expect a stop to be, and then play for that. Play for that extremely fast break. One of our traders is excellent at this type of trade, meaning that he's in the market for, in some trades, under a second, but still able to take 30, 40, 50 ticks out of the market. It's about being able to plan this stop point and also having a clear process as to how you execute that trade and how you exit the trade as well. So we'll look at that in momentum explosions and exhaustion. And then finally, we'll move on to momentum reversals. Different ways that momentum will end and ways you can play it. So not the absorption end to momentum, but how you play different versions of this. Catching stops. So the opposite of a stop hunt is the other side of that trade. How do you catch a stop? What's the inherent danger? What's the sort of percentage play, as I would call it, on this type of trade? We'll look at personality shifts. So how the auctioning pattern shifts as a move goes. And this can allow for a reasonably quick momentum reversal. So it works in a similar way to an absorption. However, it's a much faster shift in the action that then allows for that reversal. We'll look at a couple of sort of short-term, more scalp-based reversal, more momentum reversal trades as well. The high-low volume reversal. This is one of my favorites in terms of being able to get in right near the low of a move. Often when you get a sort of rejection candle, the easy thing to think is, oh, well, how could I have got in at the bottom of that candle? You know, you think you have sort of a hammer candle or a shooting star candle. You want to know how you can get in at the bottom of the wick. That's what a high-low volume reversal trade does for you. We'll show you some of those. Looking in different markets and also using the high-low volume reversal to then passively enter for a second wave move. This is sort of a short-term scalp, as to is a scramble trade. A trade where you know that people have got themselves trapped and you play against that for this very quick sort of float up. Different to a layering idea, but the movement has a similar kind of function. Light volume and very quick, so it feels like it just floats off a low or floats away from a high. So we're going to have a look at each of these different sections. Okay, onwards then. First thing we're going to cover, a trigger trade. Now, this is quite a technical trade. The point is here though, technically, yeah, it looks great, and I'll explain this in just a moment. It's about the momentum that comes in. That's the key bit. You want to see the momentum come in as you pass the trigger. Now, what a trigger does for you is defines a little bit of a clearer point to enter, as opposed to, say, a more technical flag break. So, example here, you have a market that trades down, creates a flag, but if you look at what happens in this flag just in here, we trade through it. If you sell the break of the flag, the market comes back up, closes above the flag. This is where people get pushed out on flag trades. Unless they're going to put their stop up here, this becomes a difficult entry point and one that puts you immediately under pressure. With a trigger, what you will often get is a situation, as you can see on these two blue arrows, where there is a level above the main level you're looking to break. So in this example, you'd be looking to play the flag to break this low. Now, if you have that situation, these two lows that appear here provide essentially the kind of the last potential stop. If the market's going to go down, once it's past these two lows, the idea is that it will reach this low, and if it reaches this low, the market is going to drop. So that's the idea of it being a trigger. It's the level break that sets in motion the action. The good thing about any kind of trigger trade is it gives you an execution zone. Unlike just playing a simple break, where you wait for this low and you try and hit it, that provides you one price to execute. You hit the low, either you hit it, get in and it goes, you hit it, get in and it doesn't go, or you miss it. And that's the problem. Because there's going to be so many people trying to play for that break, it's very easy to miss. There's only going to be so much liquidity sitting at the level, and a lot of people who are all very aware of the level to try and hit. But by identifying a trigger, as long as you see some momentum in here before you reach this low, you have a clear execution zone. And the way to think about this, and we looked at this very briefly in the earlier parts of technical trades as well. The way to think about this is any price between the trigger and the low is a good price to sell. As long as you've got that little shift in momentum, any price is good to sell. You can place your stop back above the trigger, which gives you a clear risk on the trade. So essentially your maximum risk is the difference between the low and a few ticks above the trigger. The expectation is that once you break the low, the move's going to go. The advantage of a trade like this is if you can get in just under the trigger, you now may be 10, 20 ticks onside by the time the break actually comes. Meaning that you can confidently hit into the break, and even if it doesn't work, you won't suck your average price down. Or you won't suck it down to a point where you're always going to lose. So you're trying to create yourself a situation where you almost can't lose on this trade. And the only way that you're not going to get a good result is if it actually doesn't break. Once the level breaks, being as it's a breakout, and I often get questioned on this, how do you place a stop on a breakout? Your expectation is what guides your stop. So the expectation is on the break, the market will move quickly and it will continue. If it does not do that, that's your stop. It should put you straight on side on the break of this level. If it doesn't, it's not the breakout you thought it was, and therefore you do not want to be in this trade. The great thing about trigger trades is they are fractal, as in you could have a trigger trade like this on a 5-minute chart that actually plays into perhaps not just breaking this low, but if you've got another level of much more significant, say hourly or daily level below there, the short-term trigger plays into a short-term break, which then essentially is a trigger for a much larger break. We're going to have a look at an example of this, using news to go with it as well, a very fast trigger and break. So let's go and have a little look at first example. This is one in gold that we're going to look at. Gold's very good at illustrating momentum coming in. So we'll use gold a bit, we'll look at oil, we'll look at S&P, we'll look at numerous markets along the way for this. So what we're looking for here then is a way of entering this trade. Now, the idea of the trade here then is to play for the break of this low. This is on an hourly. That's where we're going for the break. So you've then got to try and identify how you can get into this trade. This is the low at 12.6, which is over here. This is on a shorter time frame. This is a 1-minute chart. Apologies, this is a 5-minute chart. There's your low, which is over here. And we can see then we get this clear stabilization. You get as well this attempt up and the market then rolls back down. So you now have a very well established execution zone. If you get any kind of pace coming into this area down here, where that little blue box is, you now have 30 ticks to get yourself into this trade, with the expectation that if the market breaks the low from over here, we're going to get a continued move through this range. Bear in mind, this low also coincides with the VPOC of this composite profile over here, so you've got a fair bit of scope for movement. And a target ultimately all the way down towards 1899. We're not going to look at the entire move all the way down to there, but the first bit of the move takes you down to around about 1906, 1907. So it gives you 50, 60 ticks very, very fast with a maximum of 30 tick risk. But as you'll see, when you get into the execution zone, you don't need to take on such a large risk on this trade. You can take this on with a smaller risk by getting in close to the top of this zone. As soon as you see the momentum come in as you drop below 15.5 or see momentum within that area, that's the point to enter the trade. Here we are then. We're going to go and have a little look at this move through the execution zone. See the action coming into this. What you're looking for, and your focus should be on the move through 15.5 to start with. So just down here, as we come through there, now you can start to look for the break towards the downside. Try and get yourself into position here. Okay, what we're going to look at then is this move down into the execution zone and then out of the bottom for your entry on momentum, and then the payout that you get where the momentum really picks up once you've followed through the low. Key area to focus on then, 15.5, this level just down here, that's what gets you into the execution zone. So you're looking for some kind of momentum within there. Now, you can play this just purely as a kind of technical, if you get below 15.5, you can sell. And that's one approach to doing this. You've got a few references from the last time we were down here. You can see there's some volume down at 15. So that might be a small indication of where you could get into a trade. But at this point, it is purely just a case of wait and see on this. Let the market find a reason, or look for a reason to get in. It's a little moment of movement there, but that's not a great deal. But it has been steady. If you've just seen 16.3 to 15.7, reasonably consistent, bang, bang, bang. There you get a little snap down to 15. That's going to be good enough in terms of getting yourself in quickly. You can look at that. We've just seen it drop from 16.2. So in terms of what I'd be thinking now on this trade, if I can get in passively below 15.5, wonderful. We saw that the little bit of pace, the little bit of momentum came from 16.2. So you're thinking, right, I can place my stop around about here at this point in time. More sustained time below 15.5, more conviction that this is going to go. But this is where you don't really want to build your position too much. You haven't had too much confirmation. We got this little pop of momentum that took us below 15.5, but nothing more. So you're now in and waiting for the continued momentum to come through. Otherwise, you do run a risk of around about a 10 to 15 tick loss. So at this point, all good. Now you want to be watching what happens as we start coming down towards lows again. And this is the thing with momentum. It's just about trying to see this slight difference, this slight shift in the way the market's trading. So you can see here, it's quite stable at this point. Short of 15.2, wouldn't be too inclined to add on to this trade. I want to see a more sustained selling pressure, more one-directional trade here than what we're currently seeing. So there'd be no reason then to add on to this trade at all at this point in time. I want to see When the market moves, I want to see sell, offer moves down, sell, offer moves down, sell, offer moves down. That kind of action, and we're not currently seeing that. You're not wrong, and as I've mentioned before, not being wrong is not a reason to get out. You're just not being shown that you're right on this in quite the way that you would like to be. But still, the low is down at 12.6. We've still got space to enter this trade, and a very big expectation on the trade as well. So we're looking for one of two things. Either faster orders hitting into bids or larger volume coming and hitting into bids. And at the moment, we're not really seeing either. So you'd still be quite happy with your 15.2. Sitting on this trade, waiting for something to happen. If you get nothing, and there you go, little pop down, much, much stronger movement. Now you'd be much more willing to try and have a go. And you can try and do this passively as well. Anywhere in this zone is still good to sell. So you can try and do it passively, but because you've just seen that pop, somebody's clearly got some business to do and they've gone bang and hit the market down. This now should get your eyes on 12.6. If we get down there and we maintain a little bit of pace, you don't need much, you just need it to not rotate back up. We start coming down here towards 12.6, then you can hit that. You hit the 12.6, looking for the rush down. Now, we've seen, and this is part of any kind of order flow trade, watching how it trades down. We've seen little spurts of maybe 7-8 ticks at a time. There we go, we see another little spurt down. And this is where each time we get this little flick down, the market does rotate back slightly. So the momentum is there, but it's not sustaining itself to a great degree. Over the course of this move though, once you get the little drive down, it's not giving you too much more than that. And there you get the rush down. This is why having a trigger is so key. Because there was no chance we were going to hit 12.6 there. We'll look at how else you could as we go forward, but ultimately there wasn't really a great deal of opportunity to hit 12.6. Now, once that trigger's broken, your stop goes above 12.6, so back into that execution zone. Like I said, if it's a breakout, this is what you expect. You expect the market, when it hits that level, to put you instantly on side, or virtually instantly. You don't want it coming back, and if it's not coming back, great. This is saying you're right. This is enough. So you can stay in this trade now, and now you can start thinking about targets that you have further towards the downside. First point of call, of course, is going to be to go and break 10. Don't be sort of put off by the 20 tick bounce here. That's absolutely fine. You have to think now about what your objective is on this trade. If you're looking for potentially the move all the way down towards 99, that is still a move of 110 to 120 ticks. So a 20 tick pullback is perfectly acceptable. It's less than a fifth of the size of what you're expecting. So if you get out on a 20 tick pullback, you're giving up a huge amount of potential profit by being sort of pushed out on one little rotation back up. But that's the idea of the trigger. It allows you in, gets you into a position. As you get those little picks up in momentum, you only need a little bit in that execution zone to be enough to just maintain the movement down. Once you get the drop, now we're in a good place for the move. Now the market stabilizes, and as I say, as long as you're below that break point at 12.6, the market can continue to move towards the downside. So I'll show you this from a 1 minute perspective, and this is what it looks like. This is the move that we got into to start with, that steady movement down. It doesn't rotate back up out of the trigger zone. It steadily ticks down that zone, and then you get the pace through the low. Once you've had that, and as we were seeing in that phase that we just looked at here, the market then stabilizes. That's fine. You've got to think about the bigger perspective here. What are you really looking for on this trade? And once it puts in this leg of the move, then you've got what I would call a second wave. After that, you can now reconsider whether you're going to go all the way for the 18.99. If so, your stop stays up here, back above that 12.6, and you wait the move out. This takes a long time. This break comes at around about 1 p.m. UK time. This final break comes at around about 3:20. So very, very wide time between the two. We'll look as we move into momentum exhaustion and momentum explosion, why one might be willing to get out here on that second wave down rather than hold on. If you get out down here, you still give yourself the opportunity to play this trade, and you get another mini trigger. You get this low within the flag. So rather than playing the flag, and you could play this as a flag break, it actually works, despite the fact this isn't really much of a flag, being as your pole is as big as the flag. But it gives you a little reference point. Once this low goes, the expectation is you'll reach here. That's the whole idea, that as long as you have enough momentum on the break of this low at 1903, that will give you enough movement to get to this low. If you get to this low, that gives you a shot at breaking the 18.99 level. So that's your second trigger. I'll go and have a little look at this now. This is a quicker one. Okay, this is the second wave then. The second version of this move down. We've had the flag break. You're now starting to see the market pushing down. Not a great deal of pickup in volume at this point in time. So it's all about just looking at the way this trades, that little bit more pace that comes into this market. So here we are, trading down towards 04. We know where the recent low is, just around about 01. That's the point where you're looking for the next leg of the move. Now you see it down to 03, and we've just seen reasonable little bit of tick, tick, tick down, and that's all you're looking for. That little change that we saw just there should be sufficient now to be willing to have selling 03. You see there that extra little attempt, there was a few stabs down. You saw the last traded quantity, bit of speed in which it comes down and hits. That's good, that's what you want to see. You have to accept, particularly in a market like gold, that you are going to get these small rotations away from you. Going 2 or 3 ticks offside is the variance in your entry. You know, don't be put off by that. You are below 03, and you see there it cannot turn that momentum. It can't get a move back above 03. It finds it much easier when it sells to hit into the bid and move an offer down. Even though we're not sort of rushing down, you saw again there, a little attempt up, immediately sellers come back and hit. So there's this kind of speed within the range, within this area, of sellers being willing to come and hit any bid that comes up towards 02.9, 03. So now you want to see this momentum translated into directional trade. There's clearly a willingness, a pace with which people are willing to hit. It's almost a kind of absorption continuation. So we've seen that. You now want to see, there we go, little snap, 2 or 3 prices, that's looking good. You want to see that sustain now. So less rotation up, more hitting into the bid, into the bid. But notice we're not getting any kind of bounce at this point. It's similar here, and I'll talk about this a bit more later on, to a pressure build scenario. Pressure builds up, market's ready to go, break comes. So here we go, starting to push down. Now we're starting to hit a little bit more freely. Took out a few sort of 20s and 30 lots. You've got a bit of liquidation from the large orders. We can hunt that, you can use that to execute into as well. As long as we get this pace down, there we go, this is looking good now. You keep on getting, it's very similar to the way it did it here. These little sort of push, push, push. That's all that you need to see. And if you just note the difference, when it moves back up, it's much slower. It will sort of tick up, you may get a bid, but you don't see too much more than that. And momentum is a more subtle thing than I think sometimes people give it credit for. People, I think, assume that momentum will come in, it's a bang, 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 relentless trade. It's not that, it's about that change in the way the market trades at different points in time. And it's the way that this comes down. You see there again, it comes down, when they try and fight back, the offers come straight back in. This should give you some confidence now to go and hit into that 100 lot. You can be willing to hit it the first time. It does go down, doesn't rush straight the way through, it does hold. But it has been defeated, the pressure's remaining, and now the market's dropped straight through that 99. If that was your objective originally, there's your target, job is done, you can get out of this trade. Another breakdown, and you can then exit further from there as well. But that's what you're ultimately looking for. It's that momentum that comes in that execution zone in here. It only has to be subtle. As long as it's just showing that sellers have got more strength, they will push the market down, whereas buyers are kind of, they push it back slightly, but without a great deal of, I guess you can almost call it enthusiasm. When that happens, then you're seeing that shift, that balance of power coming towards the sellers in this instance. That gives you enough to then have conviction to sell. You've got a clear stop above the trigger, and then you can go and hit it through that low as well if you get the momentum to support that. So there we go, a more sort of technical trigger. What we're going to have a look at now is a fast trigger. This is one on news. So this is still all about having a good technical understanding of what's going on. But in this case, what we're going to look at is a break of a low. This is not just, and we're talking about trigger trades being fractal, this is not simply a break of a low. This is a break of a multi-year low. This was one in oil that went through the 2016 low. This was in April 2020, coming down into this move, break through that low, break through the 2016 low and this was actually March 2020. And so you're moving into areas we've not been to for 4 years. So it's a very significant level. But we have news, and we have this trigger at 69, and then you have a further trigger down at 50. As soon as you see pace come in, and this is going to be different in terms of the pace, this is much, much faster. This is real sort of strong, heavy momentum. You then are going to try and enter and add to the trade quickly. As soon as you see that momentum come in, you've got 69 to 50 as your point to enter, with the expectation that having broken 34, which was the previous yearly low, you now have a new low just below that at around about 17. You're then expecting an acceleration through there. Once the acceleration comes, the objective of this trade is complete. And that's all he's looking for here, looking for the market to rush through that low, quick zip through and drop. That's everything that you're after in this case. So it's about fast execution here, not about sort of steadily increasing within that trigger zone. As soon as you see momentum within it and seeing very fast momentum, you need to get in as fast as possible. This way, you're keeping your average price as close to the top of the trigger zone as possible, or as you can. Okay then, we're gonna have a little look at this. Momentum comes in, and this is the move down from 69. Currently, as we join, market's trading at 60, so we've just moved through the trigger. 25 lots has been entered onto this trade. So quick short as the market's dropped through 69, with the view that if you can get more in before 50, wonderful, and we can then target a break of 15. Bear in mind, this is moving into the pandemic. Oil is particularly volatile at this point in time. So here we go. Add, and you see how quickly that average price dropped down. As soon as you saw that pace from 63 down towards 50, the momentum increase, hit. The idea then is to get in before you get to 50. That's the objective here, on the basis that when you break 50, this market should now accelerate towards the downside. Okay, so coming into this, we've just seen drop from 63, you had a 25 lot position then. As soon as you saw a bit of pace from 63, 53, bang, 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 hits more in. So straight up towards 75 lots, and then again and again up towards 150 lots. The idea being to get in as fast as you can before we reach 50. Once 50 breaks, the position's good. You've got everything you want now. The idea is you get in above that trigger, in this case between the two triggers, and you can now sit back. Your objective now is to reach the low of the day. That's where your target is. So, holding on to the trade. How's reduced 50 actually on that first little flick down? I think expecting this on the news to have gone straight for those lows. But nevertheless, still waiting, keeping eyes on that 34. You see the mouse hovering over 34. We get the snap through, we break the low. That's the objective achieved. So as soon as the low's broken, position starts to get cut down. Cut 25 out of the position as well. So we've had around about 150 from 55, 150 of them had gone by around about 40, so just above the level. Arguably, I think that was slightly unnecessary, but he's gone for the trade through 17, position cut down. Now looking, as long as it's got some momentum and you're still seeing that selling pressure, now looking to try and keep some of the position on. Scales down again, so you've got 50 lots left now. And you see there, the momentum struggles down at 94. We've pulled back, we're back up above 01, now down towards 25 lots, and now out of the trade. As I say, the objective of this trade was purely to get through the 17, which is just here. So once that's done, there's no need to stay in the trade anymore, out of the trade, and waiting for the next leg of this move, the next opportunity to come through. And we do get another one. We get a second leg. As we come down here, bearing in mind this first low is 94. So we get 94, you get a small break of 94 and the market bounces. If you're going to try and play the second leg, then being aware of 94 is very important. Being aware that clearly this market is struggling down here, 94 to 98, this kind of zone here. That is a reference point for future. You've seen this from the flow, you can see how we traded there. Kind of trade in and it becomes a bit more two-directional. This is the point to break as we move further forward. So no positions held on at this point in time, and it's only then later on where he'll then move into this into the second wave part of this move, and we'll skip to that in just a moment. So complete move down, struggling to push through the absorption. Now we start to see much quicker bounce back on this trade. So no position taken on the trade. We're now going to move forward a little bit to the next part of the trade. 12 minutes later then, that's this bit here. Remember we talked about that 98, 97 area. This effectively is your trigger once more for another move down. Same principle. Once you break that low, the expectation is we're going to reach this low and then the move's going to continue. So he's tried it. It didn't go immediately. That was the expectation as it did last time. But he'll be persistent on this. We just see what you're watching for is where's it rotating? Back up towards 08. Now looking to have another shot at this trade. So, same principle, back to 99, sells. Now the momentum comes in. We've been to 99, we're now getting this much quicker move down towards the low. Same idea, if we break that low, then you're looking to exit the trade. We've not got levels to reference down here either. So as the market breaks, the idea then is that once it breaks, now you can start reducing the position somewhat. Sorry, phone call. So position now starting to get reduced. We've gone through that low. As I say, purely the objective here is just to reduce position now, get out of some of this trade down towards 25 lots now, and then just going to keep on edging parts of this trade out. This is much more a kind of scalped break. Yeah, this was the main break here. This is more of a kind of scalp trade. You've got the opportunity to play a mini trigger to break the current low of the day. Once it breaks, it's then got bids laid lower down just to try and flick a little bit out on each further stab down. Once it starts to struggle, then it's just going to be a case of scaling this position out. You're not looking for too much more. Every time that it doesn't rush further towards the downside, then going to scale a bit more out. And there you go, bang, 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 out of the entire trade. So a very different situation to that first one we looked at, much faster. Market drives towards the downside, and it was the pace that came in up here to start with that gives you the first entry, and then the willingness to have a couple of shots at this scalp trade. And the real sort of big takeaway from this one is that as soon as it shows that momentum and it's quick, don't hesitate. You don't need to wait for it to get to certain points to sell. If you can hit quickly, you increase your size before you hit the next trigger. And by doing that, you're now in a great position to then let that move go. You've got that extra comfort, but it's about using that momentum. It's going to tick, tick, tick down, hit it, and that gets you in the right place to be able to play onto that next leg of the move. Okay, next thing then is a passive LVN continuation. This is a trade that you can take on after the news. If you've missed it, if you've missed the breakout, any of those types of scenarios, perhaps if you're somebody who doesn't like to try and play the break, the selling it into the low or the buying it into the high trade, then you can use this. Now, the example that I've got drawn up there, what you're going to get with any kind of momentum move are little pockets of low volume. And we looked at this when we did market profile, so we didn't spend loads of time on this. Essentially, what this means is that sellers have been completely taken out. All of those offers in this example will have just been taken out in one quick move. So once they've all gone, that's telling you something. Buyers are completely in control. And if you're a seller, you have no incentive to come and sell down in this area, in this red box, because the last time you put an order there, boom, it got wiped away. So there's no reason to want to sell. As such, sellers are then going to move their offers higher up. Buyers are also going to be forced to pay higher prices. Anybody who didn't get filled on that first jump is now going to be aware of that, and they're going to realize, well, if buyers are very strong here, you're perhaps going to have to move your bid up to find a point where buyers are weak enough to allow the market to come back. That's the way to think about it. Buyers are extremely strong here. On a pullback, some buyers will step away. So they become marginally weaker for a very short period of time. You can buy above the low volume node. With a trade like this, it is a case of being aware of what those points are, and this can often be 5, 6, 10 prices. Being aware of those reference points, and as the market rotates back, then looking for it to slow down, to stall, that's where you get into the trade, waiting then for at least a break of the high, and ideally the same again. Each time you get this, you can add above it. You get it again, you can start placing your passive bids there, wait for the market to roll back and fill you. Now, this is something that can occur very, very quickly. This isn't a sort of long, drawn-out move. You can see this type of action over a 3-minute move. And within that, you get these little pockets. And this is why you can't really see it on a chart, because over, say, a 3-minute move, which is red candle, red candle, red candle. If you have this, if you look at that profile on your ladder, that then says now you can enter at these different points. You can use that as your point to scale into the trade. Add on if you're already in, get in if you're not already in. That's the advantage that it gives you. It also gives you a trailing stop. You can constantly move your stop behind these points. Once you start trading in and through that LVN, then you can get out of the trade. Essentially, it's a very short-term trend move. So let's go and have a look at a couple of different examples. What we've got here then is a move down in the euro. I'll show you the context on this trade in a little bit, but it's a move down the euro. The big level is 105, so that's this level just here. And we have spiked through that to 104.97.5. But that's the big level to break. And that's going to then lead to a continuation move down. And we get a couple of little bits in this. Not only do we get the break of the level and the passive LVN trade, which is the bit we're focusing on, you actually get the opportunity to enter as a hit and run. You get this large order at the low, and this is exactly where a passive LVN trade can be helpful. Because if you don't manage to get in and hit through that large order, then you end up trading somewhere down here. All of a sudden, you're looking at this thinking, well, the level's all the way back up here, so your stop technically has to be up here somewhere. But using the LVN, you can now get in passively. You get in as the market pulls back, you can sell. First opportunity is around about 89, next opportunity comes in at around about 78, and then, this is key, you see this down here. The LVN is formed, market does not sustain the movement below it, and so that's where your stop goes, above that area, that little pocket of volume. As you start moving into the LVN, that's where you can then start to exit the trade. So let's go and have a little look at this one. Here we are then. We're just around about 105. You can see the recent low, 104.97.5, as I said. And so if you're looking at this as a trade and you're thinking, right, I want to get short the euro, you've got to ask yourself, right, how am I going to go about doing this? Now, the first obvious point is to say, right, well, you can hit it through that low. But as I'm sure you will have noticed, as we start to approach that, you can see 600 lots below. So there is a danger that you hit it through the low, it hits into that sort of 590, however much it is, down here at 0495, 580. There is a danger that the market does that if we don't have sufficient momentum. And this is why some people may be a little bit reticent to hit it. Nice bit of pace though, nice and quick down to it, and it's gone. So straight away you can hit this, and it does bounce. So that's a bit of a danger. If you're not in and it's done, or if you are in and it bounces, you want to keep your stop up here at least, above that 97.5. And now you start seeing the pressure come in. There's your first little pocket of low volume, but now you get the real drop. And you see there, volume starts to be built up. In particular, I think one good way to do this, whenever I'm looking at a passive LVN trade, you've got an obvious area, and it does take a little bit of time for it to show. That until you've done volume in a new zone, which is starting to form down here, until you've done volume there, all of this could be an LVN. So you have to establish where that's going on. You don't need to rush on a trade like this. You've got to be reasonably quick, but what I mean is you can let the market show you and then get in. So we've got the quick drop. You can now look at this, sell from 88.5 with the view that, and if you're looking at how precisely to do it, I'm always looking at what's the lowest volume within that. So 90.5 is that point. You don't really want to see it above there, but we also know that 95 is the point where that large order came in. So you're risking 7 full ticks on this really. 7 to 8 full ticks if it goes back up above 95. Bearing in mind, this is the break of the 2017 low. So we've not been this low in the euro for over 5 years at this point in time. So there we go, we see very little trades into that 22, small tick through, that wouldn't be enough to get you out. And the more volume that accumulates lower, the happier you're going to be on this trade. So this is where you could add on to the trade. This is where you can also look at this and stay in the trade. So you're now looking next leg down. Get a little bit more pace, that's sellers taking out the buyers. There we go, nice and fast down now. That's what you're after on this trade. You get this pocket of volume up here around 76, 77, 78 area. That's where you can sell. Next point of very low volume, up at 80, 82. That's where your stops can get placed now, just above those levels, or above those points. But you're using this drive down, you saw it there, that drive down is what causes the low volume. So you can use that as your resistance. And you can look then to continue. This is particularly useful in a situation where we have a market that we don't know any levels down here. We haven't been down here for many, many years. So it's hard to decide where precisely you'd want to get out anyway. By using the information that you get from the ladder and the way the volume gets generated, this allows you then to stay in this trade, to hold on to it until you're shown otherwise. We see again there, we trade up 76 and it's very quick, it's very easy to drop. It finds it much harder to bid back up. So once more, down towards 68, we start to push through the low. No real bounce off the low. This is good, 64, 63, 58. And again, there you go, you see bang, bang, bang down once more. Quick flick back up, same principle again. You're seeing that the low volume is just above, up here at 64. You can now look at this as your opportunity to sell once again, 61, 61.5, with your stop up here. We have just dropped quite quickly. So there is a sort of a danger that we're going to start trading into this zone again. Bear in mind, this is the third time that we've had this sort of slam down. And you do also, if you notice 58, there's a bit of absorption from buyers down here. So you'll be very aware that if we start trading 64, you want to be out of this trade. It's hard to do it with your finger, but the idea there is, and you could do that just purely with a stop. Place your stop at 64, that's going to get you out of the trade. That's how you use that LVN then to continue to get out, or to hold onto your position and then get out of the trade as the market moves. Note though where we move back to. That's where your LVN was previously at around about 80. You can see offers that we've still got up here, and we then move all the way back. You get the opportunity to sell again using this original LVN as a way of playing for the next leg of the move and another shot at the low. To give you a bit of context on this trade, this is where you are. This is why that 105 was such an important level. We formed a ledge from a profile over here. We get a bad low over here, but also coming into this, you've got a significant shift in delta. 2 days where we've had high volume, the delta has all been to the downside. There's clear selling pressure in this market. People want to sell. And so that gives you the clue and the conviction to play to the downside. You're already in a very bearish market, and you now break into the lowest levels in 5 years. That's why you're going to be wanting to be on this trade, and the LVN gives you a way to either get in after it breaks or to add on if you've already got that position.